Slow zoom on a Federal Reserve press conference. Cameras click. A man in a gray suit adjusts his microphone. On a Wednesday afternoon in Washington, D.C., a single sentence can move $11 trillion. Not a policy, not a law, a sentence. Sometimes just a word inside that sentence. Patient instead of measured. Transitory instead of temporary. Traders in New York, London, and Tokyo don't wait for the meaning. They react to the sound of it in milliseconds before most of them have even finished reading it. Here's the part almost nobody tells you. The Federal Reserve does not actually control the economy the way most people assume. It doesn't set the price of a house, a car loan, or a paycheck. What it controls, what it has only ever really controlled, is expectation. And expectation, it turns out, is the most dangerous force in the entire financial system, because it can be wrong for years and look right the entire time. That's the mystery at the center of this story. Every major financial rupture of the last 100 years, 1929, 1987, 2000, 2008, even the strange, violent whiplash of 2020 to 2022, was preceded by the same quiet phenomenon, a signal hiding in plain sight, dismissed by almost everyone until it was too late to matter. And there's growing reason to believe that signal is flashing again right now, buried inside the plumbing of the bond market, the Fed's own balance sheet, and a data series most people have never heard of. By the end of this video, you'll understand what that signal is, why it has fooled nearly every generation of investors who came before you, and why the people who are paid the most to see it coming are usually the last ones to admit it's already here. But to understand the signal, you first have to understand the machine that keeps producing it, and that machine was born out of a disaster nobody wanted to talk about. Setting the stage. The machine behind the curtain. Most people think of the Federal Reserve as a government agency, like the IRS or the FBI. It isn't. It's something stranger. A quasi-private institution created by Congress in 1913, made up of 12 regional banks and a board of governors in Washington, designed specifically so that no single president, party, or bank could ever fully control it. That design wasn't an accident. It was a scar. Before the Fed existed, the United States economy ran on panic. Real, literal, recurring panics. 1873, 1893, and the one that finally forced Washington's hand, the Panic of 1907. In that crisis, a rumor about a failing bank in New York triggered a run so severe that the entire national banking system nearly collapsed in a matter of days. It was saved not by the government, but by one man, the financier J.P. Morgan, who personally locked the country's leading bankers in his private library until they agreed to pool their money and stop the bleeding. Think about that for a second. In 1907, the fate of the United States economy depended on the goodwill of a single private citizen. That terrified Congress enough that 6 years later, they built a permanent institution to do what Morgan had done. Except this time, it would be powered not by gold in a vault, but by something far more abstract, confidence. Here's where the story gets its first twist. The Fed's founders promised the public that this new institution would prevent panics. What they didn't fully grasp, what almost nobody grasped until decades later, is that an institution built to manage confidence can also manufacture the very excess that leads to collapse. Because when people trust that someone is watching the system, they take more risks inside it. That single contradiction, an institution meant to prevent crises accidentally seeding the conditions for bigger ones, is the thread that runs through every chapter of this story. Keep it in mind, because it's about to repeat itself in ways that would shock even the men who built the system. Origins. The first warning. Nobody heeded. The Fed's first real test came just 16 years after it opened its doors, and it failed spectacularly. Through the 1920s, the U.S. economy roared. Credit was cheap, stock margin was easy to get, and ordinary Americans, clerks, teachers, farmers, began borrowing to buy shares, believing prices could only go up. The Fed, still young and unsure of its own power, kept interest rates low for years, even as speculation ballooned far beyond what the real economy could support. There were warnings. Some Fed officials, particularly inside the New York Regional Bank, argued as early as 1928 that speculative lending had become dangerously disconnected from productive investment. They were largely ignored, partly because the system had multiple centers of power pulling in different directions, and partly because, and this part matters, the boom felt like proof that everything was fine. Rising prices don't feel like a warning sign. They feel like vindication. Then came October 1929. In the space of about 2 weeks, the stock market lost roughly a quarter of its value, but the crash itself wasn't the real catastrophe. That came after, when the Fed made a decision that economists are still arguing about a century later. Instead of flooding the system with money to stop banks from failing, it largely stood by as thousands of banks collapsed and the money supply shrank by nearly a third. The lesson the Fed took from the Great Depression wasn't avoid speculative bubbles. It was never let the money supply collapse again. That lesson would shape every decision the institution made for the next 90 years, and it would eventually become just as dangerous as the mistake it was designed to fix. The rise. From cautious regulator to market's silent partner. For decades after the Depression, the Fed operated in the background, rarely commanding headlines. That changed with a man named Paul Volcker. By the late 1970s, the U.S. was trapped in stagflation, a brutal combination of high unemployment and inflation running above 13%. Volcker, appointed Fed chair in 1979, made a decision that took real political courage. He hiked interest rates to nearly 20%, deliberately triggering a recession to break inflation's back. It worked, but the cost was severe. Unemployment spiked, farmers and small businesses were crushed, and Volcker reportedly received death threats. Here's the twist that set up everything that followed. Volcker's brutal medicine worked so well that it created a new kind of faith in the Fed. The belief that this institution, if it acted decisively enough, could always fix whatever went wrong. That belief had a name, the Greenspan put, coined during the tenure of Volcker's successor, Alan Greenspan. Greenspan led the Fed from 1987 to 2006 through the dot-com bubble and became something close to a celebrity, dubbed the Maestro for his seemingly magical ability to steer the economy. Whenever markets wobbled, Greenspan cut rates. After the 1987 crash, after the Asian financial crisis in 1997, after the dot-com bust in 2000. Each time the market learned the same lesson. Risk is safe because the Fed will always show up to catch you. This is the second twist, and it's the more dangerous one. What looked like stability was actually the slow removal of a safety mechanism. Investors, banks, and hedge funds began taking bigger and bigger risks, not despite the Fed's vigilance, but because of it. The very confidence the Fed was built to inspire had become a hidden subsidy for recklessness, and almost nobody wanted to say so out loud because the good times were, by every visible measure, very good. The breaking point, 2008 and the signal. Everyone missed. By the mid-2000s, the Greenspan put mentality had fused with something new, a housing market that seemed to nearly every institution on Wall Street incapable of falling nationwide at the same time. Banks bundled mortgages, many handed out to borrowers with little income verification, into complex securities and sold them around the globe, rated as safe by agencies that were paid by the very banks whose products they were rating. Regulators saw pieces of the picture. Few saw the whole thing. And crucially, there was a signal, a real one, hiding in plain sight for those who looked. It showed up in something called the yield curve, the relationship between short-term and long-term government bond interest rates. Normally, longer-term bonds pay more because lending money for longer is riskier. But in 2006, something strange happened. Short-term rates rose above long-term rates. The curve inverted. Historically, this single signal had preceded almost every U.S. recession going back generations. Economists inside and outside the Fed noted it, and then mostly moved on because the broader economic data still looked strong. That's the pattern you should notice because it will come back later in this video. The signal doesn't get missed because no one sees it. It gets dismissed because everything around it still looks fine, until suddenly it isn't. In September 2008, the investment bank Lehman Brothers collapsed. Credit markets froze almost overnight. Banks stopped trusting each other enough to lend money for even a single day. The Fed, along with the Treasury, responded with a scale of intervention that would have been unthinkable a decade earlier. Emergency loans, the rescue of insurance giant AIG, and the beginning of a tool that would come to define the next 15 years of monetary policy. Quantitative easing, or QE, the mass creation of new money to buy government and mortgage bonds, pushing trillions of dollars into the financial system. It stopped the immediate collapse, but it also opened a door that has never really closed since. The fallout. A decade of cheap money from 2008 to roughly 2015, and then again from 2020 through 2021. The Fed kept interest rates near zero and repeatedly expanded its balance sheet through QE, eventually ballooning it from under $900 billion before the crisis to nearly $9 trillion at its peak in 2022. For everyday Americans, the effects were uneven and, in hindsight, deeply consequential. Cheap borrowing costs helped stock markets and home values recover and then soar. But wages for many workers grew slowly. The result was one of the widest wealth gaps in modern U.S. history. Those who owned assets, stocks, real estate businesses, became dramatically wealthier, while those who depended primarily on wages fell further behind relative to the cost of living. This is the third twist in the story, and arguably the most important one for understanding today. The tools the Fed uses to stabilize the financial system are not the same tools that improve conditions for the real economy of workers and small businesses. They can, in fact, pull in opposite directions. Cheap money rescued banks and inflated asset prices. It did far less to directly help someone renting an apartment or paying off student debt. And because the Fed's traditional mandate is focused on employment and price stability, not wealth distribution, this divergence was largely treated as an acceptable side effect rather than a central problem. Meanwhile, a quieter warning sign kept resurfacing in financial plumbing that almost nobody outside of Wall Street trading desks paid attention to: the repo market, the overnight lending system banks use to fund themselves day to day. In September 2019, months before COVID, overnight lending rates in this obscure corner of the financial system suddenly spiked in a way that hadn't happened in over a decade, forcing the Fed to inject emergency cash just to keep short-term funding markets functioning. It was treated, at the time, as a technical plumbing issue. Some analysts argued it was something closer to a tremor before an earthquake. Failed fixes. Why reform never quite catches the signal. After 2008, Congress passed the Dodd-Frank Act in 2010, the largest financial regulatory overhaul since the Depression. Banks were required to hold more capital, undergo regular stress tests, and submit to new oversight. For a while, it worked as intended. The biggest banks became measurably safer. But the deeper problem, the Fed's role as the market's ever-present safety net, was never really fixed, because fixing it would have meant accepting short-term pain that no elected official or central banker wanted to be blamed for. Instead, each crisis produced a bigger and faster version of the same rescue reflex. In 2008, it took weeks of political fighting to pass a $700 billion rescue package. In March 2020, when COVID-19 shut down the global economy in a matter of days, the Fed didn't wait for Congress at all. It announced essentially unlimited QE and rolled out emergency lending programs within weeks, an intervention larger and faster than anything seen in 2008. That rescue almost certainly prevented an economic depression, but it also poured trillions of new dollars into a global economy already dealing with shutdown-driven supply shortages. By 2021, inflation, which had been dormant for nearly 3 decades, surged to levels not seen since the early 1980s. Fed officials initially called it transitory, expecting it to fade on its own. It didn't. By 2022, the Fed was forced into the most aggressive series of interest rate hikes in over 40 years, racing to undo the very conditions it had helped create just 2 years earlier. Notice the pattern forming across nearly a century now. Intervene to stop a crisis, create the conditions for the next one, then intervene again, each cycle larger, faster, and more consequential than the last. The fix is never really a fix. It's a delay, purchased at a price that gets paid later by someone else. Modern parallels. The signal returns. So where does that leave us now? Here's what should genuinely give you pause. In 2022 and 2023, the yield curve, that same signal that flashed before 2008, inverted again and stayed inverted for one of the longest stretches in recorded history, well over a year. Historically, that kind of prolonged inversion has preceded a recession every single time it has occurred going back to the 1960s, though the timing between the signal and the downturn has varied by months or even a couple of years. At the same time, the Fed's balance sheet, after ballooning to nearly $9 trillion HERS, has been shrinking through a process called quantitative tightening, pulling liquidity out of the financial system in the opposite direction of the QE era. Meanwhile, the same overnight lending plumbing that flashed a warning in September 2019 has shown renewed signs of stress in recent years, as the Fed's balance sheet has continued to shrink, prompting officials to publicly debate when the process of tightening should slow or stop. Layer on top of that a private credit market, lending done outside traditional banks, that has exploded to well over $1 trillion in size, operating with far less transparency and regulatory oversight than the traditional banking system that was so heavily reformed after 2008. Some analysts have drawn direct comparisons between today's opaque private credit boom and the underregulated mortgage securitization market of the mid-2000s. Not because the products are identical, but because the underlying pattern is familiar. Rapid growth, limited transparency, and a widespread assumption that this part of the system is different. That phrase, "this time it's different," has been spoken in one form or another before nearly every major financial disruption in modern history. It was said about internet stocks in 1999, it was said about housing prices in 2006, and it's being said today about a wide range of assets and market structures still working through the aftershocks of the fastest interest rate hiking cycle in 4 decades. None of this means a specific crash is imminent, and no signal, not the yield curve, not repo stress, not balance sheet trends, has ever been a perfect, standalone predictor of exactly when trouble will hit. Markets can stay disconnected from underlying risk for a surprisingly long time. But the historical pattern is hard to ignore. The moments of greatest complacency have consistently been the moments right before conditions shifted the most violently. 3 takeaways. So what do you actually take from a century of this same story playing out on repeat? First, confidence and risk are not opposites. They're often the same force wearing different masks. Every era of financial calm in this story, the 1920s, the Greenspan years, the QE decade, didn't eliminate risk. It relocated that risk into places most people weren't watching until it resurfaced somewhere unexpected. Second, the biggest warning signs are rarely secret. They're just inconvenient. The 1929 speculation warnings, the 2006 yield curve inversion, the 2019 repo stress, none of these were hidden. They were published, discussed, and then set aside, because the broader picture still looked fine. History suggests the signal is almost never the problem. Human willingness to act on an uncomfortable signal is. Third, every fix in this story bought time, not resolution. Dodd-Frank made banks safer, but it didn't remove the underlying reflex to rescue markets at nearly any cost, and each rescue has tended to grow larger than the one before it. Understanding that pattern doesn't tell you exactly when the next disruption arrives, but it tells you what shape it's likely to take when it does. Fast, larger than expected, and justified afterward as necessary by nearly everyone involved. The warning, and an open question. Here's the uncomfortable thought to sit with. The Federal Reserve was built to prevent a repeat of 1907, a crisis of pure confidence. And in the century since, it has largely succeeded at that narrow goal. No modern financial panic has been allowed to spiral the way it did before the Fed existed. But in solving that original problem, the Fed built something that now shapes global markets more than any single company, war, or election. Its language moves markets before its policies even take effect. Its balance sheet decisions ripple through economies on the other side of the planet. And the deeper irony is this: the more powerful and predictable the Fed has become, the more the entire financial world has learned to lean on it, which means the next real shock may not come from the Fed doing something wrong, but from the world discovering the limits of what the Fed can actually fix. If the pattern in this video holds, origins, rise, breaking point, fallout, failed fix, repeat, then the real question isn't whether another disruption is coming. History suggests it always eventually does. The real question is whether this time enough people will be watching the signal instead of the story everyone wants to believe. Closing. Call to action. If this kind of story, the hidden mechanics behind the systems that quietly run our lives, is something you want more of, this channel exists to dig into exactly that. Subscribe if you want to be here for the next one, and drop a comment with which signal you think deserves its own deep dive. The repo market, private credit, or something else entirely. I read every one of them, and more often than not, they shape what we cover next. Thanks for watching. Stay curious, and stay skeptical of anyone, including a central bank, who tells you the story is simple.